Let's talk to Susannah Streeter. She's the Senior Investment and Markets Analyst at Hargreaves Lansdown. Thanks for joining us. Let's talk about this method of listing, because it's quite rare. So how does it work, and has it paid off for Wise?
Yes, well, Wise may have flown into its stock market listing blindfold, given that by choosing a direct listing, its share price isn't decided in advance. But it certainly seems as though the payments firm really has had a smooth landing, with the shares rising more than 7% on the closing auction price, because when there's a direct listing, there has to be an auction at the start of the trading day. Once the price is then decided, then trading can begin. And crucially, as you touched on, Juliet, it means that institutional investors and retail investors get a chance to get their hands on the shares at the same time. Usually with an IPO, an initial public offering, it's run by investment banks, and they drum up support essentially for the companies to make sure that there isn't a flop on listing, that there are enough people who actually, investors who actually want to buy the shares. So by doing this, Wise in many ways have taken a risk. They didn't necessarily know just how much support there would be out there, but there certainly has been a lot, given the interest in the stock on the opening day. In the first half hour of trading, there was a real steady stream of trades, 47 million in the first half hour.
Susannah, if you look at some of the IPOs that have happened this year, Deliveroo comes to mind, a bit of a flop. On the other hand, Wise has got a lot going for it. The fact that it's profitable, quite unusual for a tech startup. There are risks, though, to this company, aren't there?
Yes. Absolutely. So, yes, it is profitable, as you point out, unlike Deliveroo. And the payments world is thought to have, a huge growth potential. But there are lots of competitors snapping at Wise's heels. And, of course, it has hard acts to follow, the likes of PayPal and also Stripe, valued at around 95 billion, although it hasn't actually gone to IPO yet, but that certainly is, with private investment, what it's valued at. So, these are huge targets for Wise, but because the payments industry is undergoing a revolution with so many more firms and individuals switching to digital payments, growth is forecast. Although Wise does point out in its prospectus that because of this competition, perhaps its fees might not be able to keep up to date with costs. It might have to be forced to reduce fees faster than it can reduce costs, and it's also at risk from fluctuations in currencies.
So it's a pretty volatile market. Just quickly, though, this is also a bit of a test for London, isn't it? A London listing. It's quite attractive for fintech.
Absolutely, particularly given, as you pointed out, the flopperoo that was the Deliveroo IPO. There were real concerns, but particularly for fintech. And also London hasn't proved a really popular centre for IPOs. Only 5% choosing to list over the past year or so. And retail investors have been excluded from around 93% of IPOs. So this direct listing is very encouraging. And yes, I think the fact that it has seen success, even though going into the listing blindfold, will mean that London is still retaining its crown, really, as a centre for fintech. And there is hope that more firms will be encouraged to list in this way in the future.